Good morning, you guys. You ready to get started? All right. So, now by the way, I kind of have to prioritize our time in here. So what I do is I spend a lot of time on things like, this stuff we just went over, because I think that's how we can make the best use of class time. Now, I'll try and cover the whole chapter if I can, but I may not get to all of it, so you got to be sure to read the book. But I'll get to as much of it as I can. Okay? All right. Now, every chapter will have a ratio. Okay? And what a ratio does is it enables you to get a deeper understanding of the financial statements. Now, in this case, the ratio for chapter 1 is return on assets. And the return on assets is net income over average total assets. Okay, now, where do you find the net income? On the income statement. So in this particular example, the net income for this company was $5,110. Okay? Then the average total assets. Where do you find the total assets? On the balance sheet. What's with the average? Well, what you do is you take the beginning, add to the ending, and you divide by 2. And that'll give you a more accurate number than either the beginning or the ending by itself, right? Now, obviously, if you had monthly financial statements, you'd add all 12 up and divide by 12. That would give you an even better number, but this is normally what's available. So the average assets in this case is $83,250, okay? So this turns out to be 0.06 or 6%, okay? Now, what happens here is, what information does this give you? Well, it allows you to analyze or to get a good grip on the cost of borrowing. So what happens here is you borrow money, you buy an asset, you put the asset to work, right? Okay? So they borrowed them, so what they did is they borrowed the money, they put the asset to work. Now, if it costs you 10% to borrow, right? You bought the assets, you put the assets, but they only gave you a 6% return. Is that a good idea? No, and of course, leverage is making money off of borrowed money. Okay. Now, suppose the cost of borrowing was 4%. It cost you on average 4% to borrow money. You turned around, you bought those assets, you put them to work, and they made you 6%. Now, is that a good idea? Yeah. Then you're making money from borrowed money. You get a 2% return on your investment, on your borrowing. Okay? So this return on assets, this is how you calculate it, and it allows you to take a look at the cost of borrowing. So you can take a look at the cost of borrowing, okay? And so you can compare the return you get on the assets versus how much it costs you to acquire those assets, okay? And of course, it also measures leverage. And leverage can work for or against you, okay? If you're spending 10% to borrow, it'll work against you. 4% to borrow will work for you. And I'm just presenting these numbers as illustrations, right? They're depending on various times, okay? All right, now the way every chapter will have a ratio. The way the chapters work is the way a ratio works, they'll ask you to get at least 2 numbers from the financial statements, compare them, either by division or by subtraction. That's how you make the comparisons. And then you get that number and apply it to something in the real world where you're actually working. In this case, it's the cost of borrowing. But you may compare it to other companies, etc. Okay, does that sound good? All right, now, there has to be a relationship between risk and reward. So what they got here, okay, what happens here is the fact that high risk should get high reward. So listen, a couple companies, one type of company is called a shooting star. And another type of company is called a cash cow. Now, a shooting star is a company that's either going to make it big or it's going to go bust. Okay, you're shooting for the moon. If your company is what they call a shooting star, it's high risk and it has to have a high reward potential. Okay, and that's how some people do business. Another one is called a cash cow. It's something that's low risk, something everybody needs, but it's not got a lot of profit to it, but it's a steady income. Okay, so if you have a cash cow, you have much less risk and you probably have much less reward. And again, it's a way of doing business. Okay. The point is, this of course I'm using to illustrate it, but there's a relationship: high risk, high reward; low risk, low reward. Okay. All right. Now let's kind of get into some other ideas here. Okay. Now remember, I mentioned that there's all these conventions that we've been following. And did anybody say, where is that written? Okay. Where did they come up with these things? Well, the answer to that is it's GAAP. That stands for Generally Accepted Accounting Principles. And what it does is it states the rules, conventions, and procedures for accounting. Okay? So it's the rules, conventions, and procedures for accounting. By the way, I've never been a great speller, so I can misspell a word. Try not to let it stop you, okay? But I can misspell a word. All right. Anyway, and this is where you find them. And they're just stated, so it's kind of like a book. Okay? Now, where does GAAP come from? Well, it's written by FASB. And FASB stands for Financial Accounting Standards Board. Okay, so GAAP is Generally Accepted Accounting Principles, that governs accounting. FASB writes GAAP, and it's a private organization, has like 30 members, and people apply for it, generally they're there for a year or two and they move on. They represent industries. Okay, now, the government agency that overlooks the accounting industry is the SEC. That stands for Security Exchange Commission. Now, they oversee the accounting industry, but they also oversee just financials in general. Like they oversee the stock market, etc. But we're taking an accounting class. They oversee the whole system. Okay. Now,
I'm sorry, they oversee FASB and GAAP?
Actually, they do oversee FASB and GAAP. But what they do is they oversee all of the financial. So they also, in addition to FASB and GAAP, they overlook the stock markets.
Okay.
Yeah. So if there's some embezzlement on a bond issue, SEC are the people who, there's a government agency that is in charge of monitoring this. Okay? And the interesting thing here about FASB is, they're kind of the head honchos and honchas of accounting. So you'd think they were kind of arrogant people. I met a couple of them, and I was surprised how down to earth they are. I met one at a conference in Scottsdale, and the guy had a quiet sense of humor. He was a good listener. I couldn't believe it. I was expecting somebody with a big ego that would pontificate, but no.
shit, it's Scottsdale.
Huh? Well, it was a convention, right? It was pretty, actually it was pretty nice.
We usually call it Scottsdale.
Okay, yeah. Yeah. Well, it was a really nice place. It was, yeah, enjoyed it thoroughly. Yeah. Yeah, it was work, but, you know, it's nice working in nice places.
Scottsdale, Arizona?
Uh-huh.
Oh, okay, yeah. Scottsdale.
Yeah. You were hoping like Scottsdale, Scotland or something?
No, I was
No,
like,
no,
yeah, I'd like
Hey,
to
listen,
go to
they'll never
Arizona.
spring for that. Yeah. Okay.
Ridiculous sounds, man.
I go there, I take a vacation on June.
All right, now, what's happened here is the U.S. started, what they said is, we're doing business in an international world, and we do our accounting according to U.S. GAAP, okay? But every country has their own GAAP, right? And we do U.S. GAAP. And this has created problems doing business abroad, because they have all these different accounting systems. We need a standard system, okay? So, what happened on that thing is, we were kind of instrumental. The international, the IASB, which stands for the International Accounting Standard Board, they are in charge of IFRS, and that stands for International Financial Reporting System Standards. Okay, so what it is it tried to get one system that was all over the world, right? And what they did is they started out by trying to find the similarities among accounting systems, and of course there's a lot of them, and build on those similarities, and when they couldn't do that, then they try and reconcile, after they exhausted that, they try and reconcile the differences. Well, as it's gone on, the U.S., who started the whole thing, has now been dragging its feet. And the IASB has become so irked, they've been threatening to kick us off. Now, and of course, when I was at that AAA conference, basically what they said is, what's the similarity between the metric system and IFRS? And the answer is they're both really good ideas, but nobody seems to be going along with it. And that's it. So it kind of got hung up. Some people are optimistic that it'll happen, and other people are saying it'll never happen. There just isn't the political will to adopt it. And again, it just means a whole bunch of people will have to learn how to do their accounting in a very different way, and nobody wants to learn that. Okay? All right. Okay, so it's kind of up in the air, but IASB, the International Accounting Standard Board's right, IFRS, International Financial Reporting Standards, okay? We're using U.S. GAAP, but every country has their own GAAP. Okay, and GAAP is the rules, conventions, and procedures for doing accounting. Okay. All right. Let's get into some of the principles and assumptions. I'm going to move that camera. And so let me do this. There we go. Okay. All right. So let's get into some of the principles and assumptions of accounting. No problem. Just saw that thing there.
Oh, no.
That was good. All right. Principles and assumptions. Okay. Now, one of the principles and assumptions is revenue recognition. Okay, so you recognize revenue when earned. And you recognize the expense when incurred. Okay, so what happens here is, don't forget, you recognize revenue when it's earned. Now, if you have not received the money, it goes into accounts receivable, right? If you have received the money, it goes into cash. But you recognize it when it's earned, not when you receive the money. The same is true of expenses. You recognize the expenses when they're incurred, but not when you pay them. If you have an expense that you're going to pay in the future, it goes into an accounts payable. Okay? Now, what's the point of that? Well, the point of that is so that you can have the matching principle. Okay? And let me start with this idea, and I'll go back in a minute. So we've got revenue recognition, you've got matching principle. Okay. And the matching principle says you want to match the expenses to the revenue they produce. And of course, that's why an income statement makes sense, because you go to an income statement and you say, and I hope it's okay if I put that there for you guys. It says, these expenses generated that revenue. Okay? Now, how does the revenue recognition principle feed into the matching principle? Let me give you an example where it's violated. So the tax code doesn't go according to US GAAP. It follows US GAAP in the main, but it does have exceptions. The U.S. tax code, what it does is something called the cash basis. So what it is the U.S. tax code recognizes revenue when you receive the cash, not when you earn it. And they call it an expense when you pay it, not when you incur it. So for instance, if you're a real estate salesman and you have a really good year, what you do is you go into your broker and you say, listen, I'm getting killed on taxes. Would you mind paying me for this last sale next year? So it goes in next year's taxes. And your broker says, sure, it helps my cash flow, okay? So what happens there is all the expenses of selling the house, the gas, the oil, the time, maybe there's a lunch involved, whatever. They're in this year, right? The revenue is in next year, and the income statement is off because you're not matching the expenses to the revenue they produce because they're in two different accounting periods. And that's how the tax basis works, okay? What GAAP says, and we're talking about financial accounting, is we want to put the expenses in the same year as the same year as the revenue. Then when you do the income statement for that year, you match the expenses to the revenue they produce. That's why revenue recognition leads to the matching principle. Okay? So revenue recognition says you recognize revenue when it's earned, regardless of when you receive the cash. You recognize expenses when incurred, regardless of when you pay them. The matching principle says match the expenses to the revenue they produce. All right. There's the cost principle. Now what the cost principle is, you record things, you record or you value assets at cost. Okay. Now, what happened here was the fact that one of the supposed causes for the Great Depression is there are all kinds of shenanigans. So, for instance, what they would do in those days is they would buy an asset, look around and see where they could have bought it for more, take that difference, put it on the income statement as revenue. And just because you could have paid more than you did, that's not revenue, right? So finally what they determined on this is the most accurate valuation for an asset is when you have two parties who bargain at arm's length, reach a price where one is willing to sell, the other is willing to buy. That's what something's worth worth, and that's what you put on your balance sheet. Okay? Now, in the US, that does work pretty well because inflation's under control. But if you're in some of these countries that have 50 and 100% inflation, you have to somehow adjust for market value because the cost becomes meaningless real quick under those circumstances. The other thing that it does is, now, you guys, pictures of Mount St. Helens erupting. I used to say, do you guys remember when Mount St. Helens erupted? But I can't say it. Well, I could say it.
Some of us were there.
Yes, I was there. But when I say something like that, I get these blank looks like, yeah, I've seen pictures. Anyway, so listen, when Mount St. Helens erupted, that land was valued at $1 an acre because that land was purchased by a railroad in the 1800s. And they did pay $1 an acre. And that's what it was worth. Okay? So you go to the balance sheet. Now, to make a balance sheet meaningful, there's a thing called a note. And so what they would do is they'd have a number, and then you'd look in the notes, and it would say, the land is valued at $1 an acre because it was purchased in 18-something by such and such a railroad. The probable market value is really such and such based on the board feet or you know, comparables or whatever. So they'll report the actual market value in a note. Okay, but the balance sheet will have what they paid for. Okay. All right. All right. And then,
So,
yeah.
so eventually, say they sold that land, would that profit then go into revenue since it's only?
It'll give you a gain in disposal of assets, yeah. Yeah. But, and again, what I was trying to do here was make a point by showing these notable exceptions, right? And in the main, it really works well. And there are exceptions, like that one that was spanned, you know, decades, it spanned centuries. So when he had something you know, priced centuries earlier, but shows up today, and I just tried to make a point by showing you the exception, because in the main, that's not, you know, that's not an issue. Okay, but here's some oddities that are memorable. And so, yeah, and could just, yeah. Okay, all right. And then there's full disclosure. Now, full disclosure is just like it sounds, disclose everything relevant to making a decision. Okay. Now, oddly enough, this full disclosure principle is, yeah.
Would it be, instead of just making a decision, would it be better to say making a business or a decision for the business or a business
Yeah,
decision?
sure. Now, Melanie, you're right. Because here's what it says is, don't forget, when I say making a decision, I'm talking about the reader of the financial statement. The primary person that you will write this for is the investor, second of all, the creditor. That's true. I was just kind of saving words, but you're right, it's the business decision, it's the reader's decision. The reader needs to hear everything the reader needs to know to make an informed decision. Okay. And oddly enough, this is violated now because there's too much disclosure. Companies are tired of people claiming they're hiding things. So they say, listen, if I got to make a decision, I'll disclose it. And of course in this electronic media, no problem. It's not like you got a bunch of printing costs. The trouble with it is the information is now kind of irrelevant because it's hard to see, you can't see the forest for the trees. So the relevancy becomes an issue. Going concern. So you have to say that you have to assume the business will continue indefinitely. So in other words, when you buy assets and put it on the balance sheet, you assume the business will be around long enough to use up those assets. If you can't make this assumption, if something's looming on the horizon that looks like it will terminate the company, then you have to revalue those assets and revalue them at what you expect to get for them if you sell them under these hurried conditions. Okay? Business entity assumption. Now, the business entity assumption means that the owner, or let me do this will make more sense. It's a true statement. This would be more to the point. The business is separate from the owner, or from the owner and creditors. Okay. So, you guys remember the fundamental account equation? You have all those assets, that's what the business owns on one side, and then you have the creditor's equity, you have the owner's investment, right? So the business is separate. So another way of saying the same thing is the business, yeah.
Is that true for sole proprietors though? Because they're not protected the same way as like an LLC?
Sure, excellent point. From an accounting standpoint, the business will always be different from the owner. From a legal standpoint, that isn't true. Because both the sole proprietorship and a partnership don't have that legal separation, and therefore they've got the unlimited liability. So you're absolutely right. But from an accounting standpoint, they'll always be separate. Okay? All right. Okay. And of course, the owner has his or her set of books, the creditors have his or her, their set of books, and the business has their set of books. Okay? All right. There's the monetary assumption. I've got to keep an eye on the time here. So this is at 10:20. Okay. And what it means is it has to be expressed in terms of money. Okay? So if you go to an income statement, it will have money. Okay? Now, there can be things that need to be disclosed, but if they can't be expressed in terms of dollars, they're expressed in terms of a note. So for instance, suppose you have an extremely talented team. If you go to that annual statement, you can see it written up such that it says, we have an extremely talented team, we're the leading edge. As we move forward in the future, we expect to be able to take the field because of our talent. That would be disclosed in the annual statement, it would be disclosed, that sort of thing can be disclosed in a note, but financial statements are dollars. Okay? All right, and the time period assumption. What that says is that it's practical, or it makes sense. So it's practical to divide time into periods. Okay? So it's kind of the idea that, man, we're doing great here. All right. It's the idea that, you know, now some of our time periods exist in nature. I think a year probably does because it's the amount of time the Earth goes around the sun, right? However, a month, a week, they're artificial, right? We made it up, okay? So, but it makes sense to do that because I can say when I compare this month to the same month last year, I can see how the business is doing. I can say, here's my monthly income, here's my semi-annual income, here's my weekly income. It just makes sense to divide it into periods, even though some of these periods are, time periods are artificial. Okay? All right. Now, let's see, how are we doing with time? All right, why don't I do this, and then we'll see what we'll put in a review. You just see how it all fits together. So, Questions, comments so far? You good? All right. Oh, yeah, thank you. And but you guys, let me know how this thing works out too. And it's worth doing. All right. By the way, the class is really quiet. It's probably because everything anybody says is going to show up there. So, if you guys are back there, you know, all right, okay. Anyway, yeah, and it'll be show up on YouTube, it'll be broadcast, okay, whatever you say. Right now, it's just me, but, yeah, okay. Okay. Yeah, that guy back there saying things like, man, I don't know if I can handle a whole quarter of this. It's on YouTube. All right. Anyway, listen. So there's 3 commonly used forms of business. Okay? So, there is a proprietorship. There's a partnership. And there's a corporation. And by the way, guys, it looks like today, it looks like today I'll be able to cover everything in class, so, but don't forget, what I'm trying to do here is, when you attend class, then if you read it before, I hope this enriches your reading. If you read it afterwards, I hope if you can take it the next step, okay? And don't be fooled, because sometimes I won't be able to get through a whole chapter, because I have to prioritize how we can spend our time the best. In this case, I should be able to make it, but sometimes I won't, the whole chapter won't be covered, okay? Now, a proprietorship, that's where one person forms a business. You go down to City Hall, you get a business license, right? It's easy to form. A partnership is when 2 or more people go into business together. And a corporation, now this is different. You actually form a being, right? You create a separate being. Now the being exists only in the contemplation of the law. It lasts forever. It can do almost everything a person can do. It can sue, it can be sued, be convicted of a felony. It can't get married, it can't have kids, and it can't vote. Now, if you take a look at mergers and spin-offs, maybe it can get married and have kids, and then of course it may not vote, but it can have quite an influence on elections. So anyway, but you actually create a being, and then suppose you create a corporation and own the corporation. Then you can go to the work for the corporation as an employee, so you're both an owner and an employee. Now the advantage to that is that if you're a sole proprietor and you go on vacation, well, you go on vacation. If you incorporated and went to work for the corporation that you own, then when you go on vacation, you get vacation pay. Okay, and that vacation pay is an expense, lowers your net income, lowers your taxes. Okay, you get a health benefit from your corporation. Okay, so you can have all kinds. So you get all those normal employee benefits. So business entity. I'm going to entity. Okay. Yes, yes, yes. Okay. So this is what we talked about earlier. From an accounting standpoint, the business is always separate from the owners and the creditors. Okay, from an accounting standpoint. From a legal entity, okay, no, no, yes. So from a legal point of view, the sole proprietor assumes all the debts of the business, okay? Each partner assumes all the debts of the business, okay? In a corporation, you're limited to the assets owned by the corporation, okay? So it is a different legal entity from the owner. You actually create that being, okay? And of course, similar concept is limited liability. So, because it's not a legal entity, it has unlimited liability, same with the partnership, and the corporation has limited liability. So if you buy $1,000 worth of shares of IBM, IBM goes belly up. How much do you lose? $1,000 bucks. Okay? So you have a limited liability. All right, unlimited life. All right, no, no, yes. Okay, so if you're a sole proprietor and you become incapacitated or you pass into the next world, right? Well, the business is over. Now, your heirs can collect the assets, right? They can inherit the assets, but they don't inherit the business. Same is true of a partnership. Suppose two of you form a partnership and one of you passes on, right? Is there a partnership? No. Now, it's easiest to see with two people, but it's true of 10. If 10 of you form a partnership and one dies, the partnership dissolves. Now, it can immediately reform. And if you were a customer, you'd never know. But if one partner died, one partnership dissolves, next day, a different partnership. Often what partners do is they take insurance out on each other. So when one passes on, the heirs are paid off with the insurance, the remaining partner keeps the business is often how they do it. Okay? Now a corporation, 10 people in a corporation, 10 are on a plane, the plane crashes, 10 move into the other world, the corporation lives on. Okay? Okay. Business taxed. Okay? And the answer is no, no, yes. So what happens here? If you're a sole proprietor, what you do is you fill out Schedule C of your 1040. That's where you list your revenue and expenses. That gives you your net income. Take that net income back to your 1040, that's what you pay taxes on, regardless of whether you left the whole thing in the business or took the whole thing out. If you're a partnership, the business files its Form 1034 with the IRS, which is for information purposes only, and it says how much net income did each partner get, and that's what you should be declaring on your taxes, but it's for information purposes only. A corporation is taxed. So a corporation can have double taxation. So let me show you how this works. Okay? So double taxation, well here, I'll put it here. This looks good. So here you have, so this is a corporation, right? So here you have revenue minus expense equals net income. Okay. Now, this is subject to a corporate tax. And a corporate tax is to a corporation as an individual is taxes to an individual. Then, do you remember when we had a sole proprietorship? Now, in here, in this class, we'll be dealing with sole proprietorship, right? Now, what the sole proprietorship did to take capital out of the business did a draw, right? Withdrawal. Now, the same thing happens with a corporation, except it's called a dividend. So a dividend is to a corporation as a withdrawal is to a sole proprietorship. Okay? And then that's subject to personal taxes. So this one net income is taxed once as a corporate tax and is taxed a second time as a personal tax. And that's what's referred to as double taxation. So now what of course happened is that's why the limited liability company, or limited liability corporation, depending on when it was formed, they're both the same, two names for the same thing. The LLC gives many of the protections of the corporation and is taxed like a partnership in that it's taxed at one time. Okay? Sometimes you'll see it called a form of incorporation, sometimes you'll see it as a form of partnership. But it only has the one taxation. Okay? Yeah.
What's the difference in the S corp?
Now, the S Corp, it used, the LLC replaced the S Corporation. The S Corporation was the form of incorporation where there was the one taxation. Some laws, and that was quite a while ago, maybe 86 or so, then kind of made it disadvantageous. And then what it used to do is now done in the main by the LLC, the Limited Liability Corporation, just because it fits the tax codes better. But then you're right, you're absolutely right, they do the same thing, just at different times in history. And it was, I think it was like 86 or something is when they changed the code. All right, let's take a look at this. Okay, now, how are we doing for time? Let's do this. The other topic I want to cover is, don't forget, this is important. Be sure to, when you read the chapter, if you, don't forget, be sure to pay attention to that Sarbanes-Oxley. And the abbreviation is SOX. Okay, like you have IFRS and GAAP and all that. SOX is Sarbanes-Oxley. Basically, what happened here was the SEC. Well, what happens in this thing is, remember when we had all those recent scandals, WorldCom, Enron, etc., and all the bogus accounting that caused it? Well, every time one of these scandals occurs, everybody gets a bee in their bonnet, run around, hang them high, you know, and then it doesn't take long before people just cut their losses, get back to work, and forget about it. Okay? And that's always happens. This has been a little bit different. Sarbanes-Oxley kind of was the same reaction to a scandal, but this one doesn't seem to be going away. So it seems to have what they call legs. It seems to be sticking around, and it has pretty severe consequences. So, and the old, you know, that excuse of my accountant lied to me, I didn't know any better, that's not true anymore. CFOs and CEOs need to sign off on the financial statements claiming they're legitimate. And if they prove to be legitimate, they can go to jail. So the Sarbanes-Oxley, these are two legislators, and it makes people more honest. And it's the reason, what's different about it is this one doesn't seem to be going away, and it has pretty severe penalties. All right, how's everybody doing? Should we have a review? Can I move this in long-term memory? Okay. What kind of accounting do we do in 201 and 202? Financial. What is financial accounting?
Report how business is doing.
Yeah. Perfect. You report how the business is doing, and then she went on to say it's investors and creditors primarily. Primarily the investor, but also the creditor, but a whole bunch of people actually use it. All right. What are the 4 general purpose financial statements? Income statement, statement of gross equity, balance sheet, statement of cash flow. All right. What 2 types of, and by the way, if you guys don't put things away, people can hear me better, and I promise I'll never keep you over, because man, that used to hurt me when I was on your side of the desk. All right. So listen, what 2 kinds of accounts go on the income statement? Revenue and expenses, sure. And what does it tell you? The net income. All right. What does a single line mean? Add or subtract. What's a double line? Total. Somehow, some bottom line. Where do the dollar signs go? Top of each column and the bottom line. Okay. What's the difference? What do you put in the left column? Itemized, right? List the individual column. What was the right column? Total. Okay. All right. How many lines in the heading? 3. What's the top one? Name of the company. Middle one? Yeah, type of the form, name of the financial statement. Bottom line? Date. Okay. What sort of a date does the income statement have? Period of time. Last month, last year, I made some money, but it covered a period of time. All right. Statement of owner's equity. Where do you start? Beginning capital. Increases or decreases go next? Increases. What 2 things increase capital? Investment and revenue. Okay, and you're absolutely right. And by the way, you report it as a net income. So investment and net income, but you're absolutely right, it's revenue. All right. What 2 things decrease it? And a net loss, exactly. Okay? And by the way, sometimes I think I'm kind of picky, but I want to make sure that I'm clear. And so you can say an answer that's essentially right, but I'd like to make sure that it's, you know, that it's zeroed in. Because it can be a very right answer, but you know, it can make a real difference. Okay. All right. Okay, withdrawal and loss. And then, of course, what does it give you? Ending capital, exactly. All right. Balance sheet. All right. What's different about the date of a balance sheet?
One day.
It's a specific day. It's like a snapshot in a period of time. What goes on the left-hand side? Assets. What goes on the right-hand side? It's in owner's equity. Okay, and you got how many bottom lines? Two. Okay, they got to equal. All right, on the statement of cash flows, how many sections? Three. The first one is cash flow from operations. You know, cash your customers pay you. Next is cash flow from investing. What do they mean by investing in this case? Buying and selling assets. You buy an asset, cash out, sell an asset, cash in. And the last is cash flow from financing, means investing and borrowing. Okay, long-term borrowing. You reconcile the cash at the account. So you have the cash balance from the beginning of the period. Put in the change. It should give you the cash balance on the balance sheet at the end of the period. Okay? All right. Return on assets. What does a return on asset tell you? And then we do evaluate. Well, it's net income over average total assets. That's right. What are average total assets? Beginning plus the ending divided by 2. Okay? And it allows you to evaluate the cost of borrowing. Okay? It allows you to evaluate leverage. In other words, when you compare the money you borrow versus the money you make off of the borrowing. Okay? Is there a relationship between risk and reward?
Yes.
High risk means high reward, right? High risk, low reward, don't do it. Low risk, high reward, do it. Okay, all right. Okay. Where do you find the rules for accounting? GAAP. What does GAAP stand for?
Generally accepted accounting.
Generally accepted accounting principles. We're using US GAAP in the US. Who writes GAAP? FASB, Financial Accounting Standards Board. Okay. What government agencies oversees the accounting industry? SEC, Security Exchange Commission. All right. What is IFRS? International Financial Reporting Standards. And basically, they want a uniform accounting system for the whole world. Okay. Who writes IFRS? IASB, the International Accounting Standards Board. Okay. All right. Revenue recognition. When do we recognize revenue? When it's earned. When do we recognize an expense? When it's incurred. Why do we do that? Because we've got nothing better to do, busy work. Oh, don't laugh like that. Don't nod your head. Anyway, don't nod your head. No, it's because we have the matching principle, right? Now, what's the matching principle? Matching expense to the revenue it produces. Sure. Cost principle. What does that mean? How do you value assets?
What you pay for them.
What you pay for. Sure. Okay. Full disclosures, like it says, disclose everything needed to make a decision. What's a going concern?
Business will continue indefinitely.
Business will continue indefinitely. What's the business entity?
The business is separate from the owner.
The business is separate from the owner. Monetary assumption.
Express in terms of money.
Got to express in terms of money. Time period assumption. It's practical divided in a time period. Okay? What's double taxation? What's double taxation? This applies to corporation.
When the corporation gets taxed, and the
Twice.
individual gets taxed.
The net income is subject to a corporate tax, and then net income, when it's passed on in the form of a dividend, is taxed in the personal income tax. So it's taxed twice. Okay? Now, what are the three major forms, the three most commonly types of business?